In this video, we're going to discuss calculating depreciation for plant and equipment types of assets for corporations and other businesses. So the first thing we need to understand is that the IRS helps us by providing us with two tools. Number one is they provide a table or at least some instruction on how to classify assets into what they refer to as a maker's class. MACRS is the depreciation system. So assets are identified as being 3, 5, 7, 10, etc. years. So what this does for us is helps us determine the depreciation expense each year for the assets. Because in addition to the classification system, they also provide us with the data, the depreciation percentage for that year. So here for a 3-year asset, in the very first year, we can depreciate 33% of the asset. So now let's go on and talk about an example. So let's say we're going to buy a new piece of equipment that costs $40,000. It's going to have a 5-year life, and it has $6,000 worth of installation costs. Now, you have to be a little careful here and understand what information you're given. I could have told you that the installed cost was $46,000, but the depreciable basis is the total cost, which is its initial cost plus any installation costs. So when you put that data in, what we find is here is the depreciation schedule for that asset. The very first year, you'll be able to depreciate it 20%. 20% of $46,000 is $9,200. Now, we're going to be replacing an asset. So the asset that we're replacing, we originally paid $35,000 for it. It was a 5-year asset, and we've beat it up pretty good. So, we only bought it 3 years ago, and it really needs some replacing. The current market price we can pay this for or sell it for is about $12,000. And since we're talking about capital assets, the current capital gains tax rate is 20%. So what information did this provide us with? Well, down below here now, we have the depreciation on this old asset. To the right of this, we also have a calculation of what's referred to as the book value. The book value is the remaining depreciation for the asset once we liquidate it. So if you remember, it was a 5-year asset. It has 6 years of depreciation, and we've had it for 3 years. So we took 1, 2, 3 years have been depreciated. The next 3 years all need to have depreciation as well. When you add those all up, that's our book value of $10,150. So what impact does this have on cash flows for the company? Well, the market price of this asset, the old one that we're going to sell, is $12,000. Its book value is $10,150. The profit is $1,850, right? That's just the market price minus the book value, $1,850. The tax, now we can calculate this tax. It's the profit, $1,850, multiplied by the tax rate. So here's the tax. We're going to pay $370 of capital gains taxes on this asset. So the total after-tax profit is the profit of the sale minus the tax. So as you can see, here is our profit after tax. That's the profit on the sale, that is. Now, what is the cash flow after tax? Well, you take the market price. We're going to receive $12,000, but we're going to have to pay $370 in tax. So the actual net cash flow is $11,630. So that is the increase in cash to the company for making this particular or purchasing this particular asset.